and welcome to Your Business, Your Wealth. My name is Paul Adams, and I am joined today by a man who you can learn more about on episode 138. He is known as a millionaire next door, Jeff Miller. So glad you could be here, as always, today.
Good to be here again, Paul. Looking
Uh,
forward to today's episode.
Now, everybody's going to be excited. Corey is going to be back in another couple weeks. He's getting close. Came into our meetings today, and I said, hey, do I get to have both of you guys on the podcast? He's like, my daughter has a fever today. Plus, we have a new baby that's not cooperating with the fever of the older kid. So he'll be joining us here in another week or two, and I'm looking forward to getting an episode together with all of us. But today we have some fun discussion, Jeff. We're going to be talking about ESG funds. Now, ESG is not like a shortcut for like what the notes are in the neck of your guitar or something, right? It stands for environmental, social, and governance inside of large corporations where they get a score, and then some asset managers will drive more to them. And the asset manager's sale to you as the investor is you care about this thing, whatever this thing is. You care about the environment. And so now you're going to do a primarily environmental investing fund, as an example. Or it could be, I want nothing that's going to support anything that's against my religion. And you could just select that. So today we're going to talk about some of the controversy that's around that, what that means for you and your investing. And then last, before we're done today, we're going to talk about a technique where you can invest just like a lot of the major pension funds do, like an institutional investor, and still use that type of investing to make a difference in the world the way you want to. Anything else we want to add about ESG, Jeff, before we get into our articles we identified for today?
No, let's go. Let's just dig right in.
Get it. All right. So here we are looking at green funds cost 3 times more than you think. Now, in a minute, and this is not usually the case. We don't usually have a problem with any of some of these articles, especially by some of the authors of the Wall Street Journal. But Jason Zweig would usually not do this, but you're going to see that 3 times as much. Why don't we give away that part real quick, Jeff? I don't even need to scroll to it, but just tell people what they're referring to in this cost 3 times more than you think.
Okay, so the starting point for this is that the fees in an ESG fund tend to average 5 basis points higher than an index fund, I believe is what they were comparing it to.
Yep.
Like a straight S&P 500 index or whatever.
Yeah, the average U.S. green stock ETF charges
Right.
0.17 in annual fees. According to Morningstar, that is 0.05 percentage points more than conventional funds.
Right. So 5 basis points, right? And then the triple or the 3 times that amount is calculated by saying that when you invest in an ESG fund, you're generally about 75 or about 70% of what your holdings are within that fund
Yes,
are the same, right?
Let
Are
me
the
show them
same
that.
as
I love that. So this is what Jeff is referring to. You can see here how it says, on average, according to a new Harvard study, ESG funds have 68% of their assets invested in the exact same holdings. So if I could say it differently, what you're saying, Jeff, is that it's because only about a third of the money is invested in the ESG strategy, but they're charging more money on the entire asset base of what you have invested. So it really is like a larger increase when you consider they're charging that much more, but they're only doing something different with a third of the portfolio.
Right. So they're tripling that 5 basis point difference to now say, the end result is that it's only 15 basis points different, even by their math. So,
and our message to Jason is that using that 3x the cost thing might have been the article title that tested better for Wall Street Journal. But I think the bigger story is that ESG funds are only doing a third of what you think they are. Because they're
Right.
not
Point
doing
number
it
one.
with the whole portfolio. 68% is invested just like their peers.
Correct. And then I think we'll get to the return history on ESG versus like a full market portfolio or a more broadly diversified
Indeed,
portfolio
yes.
or investment strategy.
So, so here's an example of what Jeff is talking about. Sustainable U.S. stock funds have 22.1% of their assets in technology, 15.4% in healthcare, but only 2.6% in energy, according to Morningstar. Non-ESG funds, meanwhile, hold 18% in tech, 14% in healthcare, 5.7% in energy. Next paragraph says, no wonder green funds outperformed over the 5 years, earning an average of 8.1% annually, while non-sustainable funds grew at 6.9% for most of that period. Tech and healthcare boomed while energy lagged. So the key is there's a whole component of the market that the clients didn't even get an exposure to. So when it comes to diversification, you were under diversified in the ESG strategy. Is that fair?
Yeah, underweighted in energy, and I would say more specifically, traditional energy or oil and fossil fuels.
Yes.
Right,
Yes.
not clean energy. So underweighted there, and then overweighted in technology / growth stocks,
Mm-hmm.
and then a little bit overweighted in healthcare.
So one of the things that I love that was in this article, so props to Jason on all of this. I usually have nothing critical to say about Jason Zweig, so our little criticalness on the title. But he shows a 2015 analysis of over 2,000 research papers found striking results. Slightly more than half the studies on corporations showed that those adopting ESG principles improve their financial results. But only 1 in 6 studies on ESG funds found that these portfolios perform significantly better than average. So even there isn't a data point that would suggest that by, people say voting your conscience, investing your conscience would produce higher outcomes, and there's no evidence of that. Now there's
Correct.
anecdotal evidence, like there might be a fund that invests ESG that outperforms somewhere else. But
just like there's an active manager that,
say more.
Compared to a specific benchmark that will happen to do that in any given year.
One of the other articles that I don't think we're going to get to today, but that Wall Street Journal released was the fact that you have to have the ability to select the whole market to have any hope of outperforming the market. So most asset managers can't outperform the index they're being compared to straight up. And then take certain investments off the table for them and now tell them they have to beat that index. It's near impossible. Or it's near, I would say it is impossible in any consistent, dependable, or predictable way. So now let's talk about one of the major things that have happened in ESG just over the last couple of weeks. And that is Vanguard CEO. The title is Buck's ESG Orthodoxy. Now, here's what Vanguard CEO had to say. A lot of respect for this company, although I do think in some ways they're a little split personality. So what Vanguard CEO did is he came out and said, what we're no longer going to do is to play in this space that is like the 2050 net zero initiative. But the reason why he came to that decision isn't what you might think. He didn't say, oh my gosh, this is wrong. I'm anti-environment. I don't like anything from tadpoles to bald eagles. Just let them all go. It's not any of that. His major stand is, I can't be a fiduciary for my clients if what we are doing as an organization with people's investments is that we are putting ESG ahead of getting returns for them. And there's a couple of really good quotes in here. Our research indicates that ESG investing does not have any advantage over broad-based investing. Now, let's just think about this. Jeff, think about Vanguard, been around for longer than you and I have been alive. I think, long time. And they manage billions upon billions and billions and billions of dollars. So this isn't like some nut small asset manager, right? This is one of the biggest asset managers in the world. And their research, now think about their research on billions and billions and billions and billions of dollars invested over many, 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 many decades across hundreds of thousands, if not millions of investors. And their research with all of that data, not counting all the third-party data they can get out in the marketplace, this is just what they have internal. ESG investing does not have any advantage over broad-based investing. Now, what does that mean? He says, in investing, you get what you don't pay for. Intelligent investors will use low-cost index funds to build a diversified portfolio, and they won't be foolish enough to think that they can consistently outsmart the market. Because keep in mind, we know, Jeff, that active managers can't consistently or predictably beat the market. And we know that, and we get like no pushback. Once you show people the data, right, Jeff, they go, that makes total sense. But inside of one of these ESG funds, it's just active management, but also you have to have a bias toward picking certain things because of environmental, social, and governance decisions they did internally. Fair? So they can't beat the market when it's just active. Then how much more unlikely is it they beat the market if they're active investing and have limited selection? So when you look at Vanguard and them saying that they can't beat the market, an active manager can't consistently or predictably beat the market, and that's when they can buy anything. What they're saying is that you can't limit the selection of what your asset manager could buy and then somehow expect he's going to beat the market. This next line is key. Mr. Buckley effectively claims that ESG managers are playing the fool and taking their clients' money with them. Fewer than 1 in 7 active equity managers outperform the broad market in any 5-year period. So that's what we're talking about. Active managers just trading with the full resources of whatever's available in the marketplace mostly don't outperform. Only 1 in 7 do. And by the way, it's not the same 1 in 7 every year. Over the past 5 years, not one relied exclusively on a net zero investment methodology. Outperforming the market, so of the people that outperformed, not one of them was doing it with net zero investing. Mm-hmm. And then last but not least, outperform the market. And this is what we talk about all the time. We talk about in the illusions of investing. Jeff's talking to clients about this 3 times every week. Outperforming the market is even more difficult over longer time horizons. Only 1 in 10 over 10 years and only 1 in 20 over 20 years ever do outperform the market. So we end up in a spot where even major investment firms like Vanguard are saying they're not making the call that it's like morally wrong to do ESG investing. They're not saying they don't believe in the premise of ESG investing. I personally think that if a large company has the support of its leadership and shareholders and chooses to do some things that are wonderful for the world, I'm all for it. I'm one of those people that believes the guy that invented the USB drive and Adobe saved more trees than Greenpeace ever would. So I'm a huge fan of corporations doing good. But the problem is when the corporation heads aren't just doing good in the world, they're trying to manipulate a score that all these asset management firms are using. So they're kind of trying to predict the black box in order to drive their stock price. That's the concern that Vanguard is worried about. That's the concern that some of these other folks, some of our politicians are talking about this right now. And the problem with 401ks by default say, our 401k is going to do this, and you as the employee don't get a choice. So here's the main point we want all of you to be able to take away. It's that if you're doing ESG, it's like the famous economist Thomas Sowell said, there are no solutions, there are only trade-offs. And you're trading something off when you do ESG investing. You're certainly at a minimum trading not full stock selection for your asset manager. You're also picking up some version of active management because even if they say it's an environmental index, somebody's got to go in every year and make very, very subjective assessments of how they're doing on their ESG or ESG scores. You see, what Vanguard's against is it's not bad for these companies to do something. You know, the guy who invented the USB drive, the people that created Adobe, they saved far more trees than any tree-saving charity. So we're all for corporate America doing real good in the world, both with their offer and alongside their offer to the marketplace. But there are trade-offs. You might get a trade-off in lower return over time. You might get a trade-off of additional volatility, or you'll end up with a trade-off with a massive lack of diversification because of certain things that are off limits for an ESG investment fund. So what can you do? Well, if you think about your investment dollars and think about all the money you have, even if you have several $1,000,000 to deploy, once it goes into one of these funds and gets sliced and diced super thin, what are the odds that some major company out there, Microsoft, Tesla, Caterpillar, is going to say, oh, we're going to change things because we got a fraction of somebody's money invested that wasn't invested before? You see, our dollars are not making somebody move. Now, if BlackRock and Vanguard say we're not investing any client money unless you follow these tenets, then that has some movement, but then I don't need to invest my money with them. They're moving them at the Vanguard level, at the BlackRock. Well, not Vanguard now, it looks like, but BlackRock might want to push them. But then it doesn't matter if my money's with BlackRock because it's not enough money. What matters is where the guy that has $5 billion moves his money, not me. So what can you do to make a difference? Well, I think one of the easiest things to assess is like, well, my ESG investments will probably get a slightly lower rate of return. But you know where we can make a big difference if you have a couple of $1,000,000 portfolio? Sit down and build an investment strategy principled upon academic allocation and global diversification. If your advisor isn't familiar with how to do that, get in touch with us and our team. We're happy to walk you through what that means, or go find our video on the illusions of investing. And you're going to see a lot of what's not told to you in the marketplace about your investments by the company who want your investments. So what you could do instead, just take 1% of your portfolio a year and give it directly to an NGO or an activist organization that you care about. Because whether or not you deploy, I know I'm going to give an extreme example, not particularly my charity, but let's say you're really against anybody hunting X in the ocean. Whatever the X is you don't want hunted, you don't want them hunted. You investing your $2 million a knot isn't going to change those vessels and their actions. But if you gave $20,000 a year to one of those companies that irritates the fishermen, you might actually get something done. And that's what I would suggest you do, is take the dollar. So perhaps you're somebody who's like, kind of cares about a lot of social stuff, but you're against abortion. Well, then give to a cause that helps with adoptions, that helps with the things that you care about. That if you're really worried about the environment, then find the environmental causes that are going to take the most action on the ground, because that $20,000 will make a difference. And by the way, you can have input by giving $20,000. The kind of input you're never going to get as a part of a large fund full of people who all have different ideas about what the ESG investment should be. And none of those ideas matter. And the only thing that matters is the big mutual fund company you're invested with, because that's what they're going to vote for, is the part of the ESG that they care about. So instead, invest your money in the free market, get the greatest return that you can, and then take what the free market gives you, a portion of that, and put it directly to things you care most about, because that is what ESG investing is about. Make the money in the marketplace and then be able to take what the marketplace gives you and deploy it directly on the ground to those causes for which you and your family care most. And that way, you can end up with a secure retirement, competitive returns, a lifetime of independence and giving, and most importantly, giving the things that you care about most in the way that's most effective for you and your family. So with that, from Jeff, who had a major technological breakdown and couldn't be here for the very last of this, from Miranda, from Corey, from everybody at Sound Financial Group, and the entire Your Business, Your Wealth podcast production team, we hope that this has been a contribution to you being able to design and build a good life.